commercial real estate price declines, a potential rebound in listed REITs, and the health of the CRE debt markets. That's what I'm watching heading into 2024. Welcome to the Real Estate Reel, where we discuss 3 data points we're watching each month. This month, we're focused on what to watch next year. First, we expect commercial real estate prices to continue falling on the back of the 10 to 15 percentage point declines shown in this chart that we have already seen from their peak. In total, we expect CRE prices to decline roughly 25 to 30% from their peak to trough, which means private CRE valuations are only halfway to our projected declines. However, there are signs that the worst is behind us, as quarterly declines are slowing. The third quarter of 2023 saw private valuations, as measured by the NCREIF Odyssey Index, decline for a 4th quarter in a row by negative 1.9%, compared to negative 2.7% in the 2nd quarter, negative 3.2% in the 1st quarter, and negative 5% in the 4th quarter of last year. The next leg lower in CRE prices may be a slow grind that plays out over the next year and a half. It will be driven by distress that is rising as loans mature and force weaker hands to sell properties. We see this sell-off and subsequent recovery creating a historic opportunity for strong returns for private real estate investing, but we believe it will also create winners and losers. On the losing end, we believe, will be many legacy funds because they purchased properties at or near peak valuations, particularly in 2022 when private funds were the only investor type that net acquired assets. Those funds have been slow to mark down existing assets given a lack of transactions that would otherwise provide pricing transparency. The result is they may not have dry powder to invest when prices become attractive. On the winning side, we believe will be new funds with fresh capital. Indeed, history shows that the best vintage returns are generated in the aftermath of markets like we're experiencing today, with post-2008 vintages as the key example, as you can see in this chart. We expect returns for the 2015 to 2022 vintages to meaningfully decline as cap rates reset higher and valuations decline in the coming years. Additionally, the property types that worked last cycle may not work this cycle. For instance, shopping centers, which were largely ignored by current private funds launched in the prior generation, are the best performing asset class in 2023 year-to-date. By comparison, most private funds that are heavily weighted to industrial and multifamily sectors have the lowest cap rates. The second development we're watching in 2024 is the potential rebound in listed REITs. Listed REITs have already priced in much, if not all, of the headwinds now facing private CRE as they lead in both downturns and recovery. Prices are down almost 30% from their peak at the end of 2021, with total returns since then of negative 24% as of the end of November. But we see a more favorable backdrop emerging. Indeed, as you can see in this chart, listed REITs have already rebounded 13% from their trough last month and are on track in November to have their 12th best months ever, with month-to-date returns of 10% as of the end of November. An analysis of the prior 11 best months ever shows that listed REITs returns have never been down over the next 12 months after those months. The recent rally was aided by a 40 basis point decline in real rates from the highs in October. Real rates, along with investment-grade credit spreads and net operating income growth, are the 3 factors most critical to the performance of listed REITs in 2024. Let's level set on those 3 data points. Current real rates are 2.1%. Credit spreads are currently 109 basis points, and net operating income growth for listed REITs was 4.6% as of the end of the 3rd quarter, according to NAREIT. With that as the fundamental backdrop, here's what we might expect for listed REITs in 2024 given various scenarios. If current real rates decline slightly to 2% and credit spreads are unchanged in the year ahead, while net operating income growth slows to the mid 3% range next year, then we would expect mid to high single-digit returns. By comparison, if real rates decline to 1.5% as the Fed continues to control inflation, while net operating income growth slows to the mid 3% range and credit spreads are unchanged, then we see potential for returns in the mid-teens. And keep in mind, listed REITs can often overshoot fundamentals to the upside, as evidenced by listed REITs returning 20% annual returns in 6 different years since 2009. We think a harder economic landing where real rates fall towards 1%, while credit spreads widen and growth slows, could produce positive returns for listed REITs given what's already in the price. The risk is that interest rates remain higher for longer. Bottom line, we think risk-reward skews positively in 2024. The third development to watch in the year ahead is the CRE debt markets. Lending conditions are undeniably tight, which is creating challenges for borrowers that have loans coming due. Investors should expect delinquencies as well as distressed sales to rise, but we don't think the reality is as bad as the media headline suggests. Here's why. First, the Fed's Senior Loan Officer Opinion Survey suggests that we might have already seen peak tightness in lending standards. As a reminder, lending standards are important because there's a strong historical relationship between year-over-year changes in CRE prices and the Senior Loan Officer Opinion Survey, which you can see in this chart. Second, MSCI recently analyzed the health of real estate loans collateral. They found that the price of 81.5% of properties securing loans has dropped in the past 12 months, but only 40% of loans are estimated to have decreased in value since their origination. This is due to price appreciation over the loan's lifespan prior to recent corrections. In other words, more loans may be able to refinance than feared. This is supported by our analysis of CMBS loans that matured in 2023. It showed that 80% of these loans paid off at or before their maturity date. Some of the other loans that have higher effective loan-to-values will be modified and extended by lenders who may not want to foreclose on properties. Bottom line, there are real headwinds facing CRE debt markets, but we think the market is coming to terms with the fact the headwinds facing commercial real estate debt will be a slow burn over a longer period of time rather than the collapse that the market feared in March. Overall, we think 2024 will mark an inflection point in real estate investing. We believe private will continue to sell off, listed real estate is likely to rebound, but the markets are in better shape than many observers believe. Thanks for your partnership this year, and we look forward to speaking with you in the next year.